Welcome to the Old Mutual Investment Group webinar. I am Maya Fisher-French, and today we have a really interesting conversation because we are not going to be talking about Trump for the next hour. What we are going to be discussing is precious minerals and how the changing demand for electric vehicles is going to possibly be a windfall for South Africa. And we're also going to look at why all that glitters is not necessarily gold. But of course, we do have to set the global scene, which means we do need to talk about the double T's, Trump and tariffs, and that will be expertly covered by Chief Investment Officer Siboniso Nxumalo. Meryl, head of Equities Research, will give some insights into the future of gold. But the star of the show today is Tana Mongwe, who has some very interesting insights into where electric vehicles are heading and what that's going to mean for the platinum industry. Now, for those of you who've joining us, please remember to post your questions so we can include them in the Q&A session at the end. But let's start with a current market overview. Sibo, I was actually going through my notes in August when I was last part of this conversation, and you were talking then about the headwinds facing America and why emerging markets were starting to look more attractive. And this was before even the tariff wars, right? Now, you mentioned recently that in order to understand tariffs, you have to understand how Trump views the world. A scary thought, but an interesting idea. Where do we stand now with the tariff wars and also the physical wars? Let's be honest. I mean, there's been a huge escalation in the Middle East over the last week.
Yes. Hi to the listeners and hi, Maya. Ultimately, what we do investment research. So we go back into the archives of history to understand how the world works and how then we will position clients' portfolios on behalf of that information. And so therefore, then I will take us through some of our thinking. With that, let's start with Mark Twain's quote, and it's often quoted, and these days it feels like it's becoming a lot more relevant. History does not repeat itself, but it often rhymes. And so for us, one of the bits of investment research that we've done was compare different regimes in the world. And how I'll tell the story is the tale of two boys. So hypothetically, we've got a boy and we've got a picture of a young boy who was born in the 1900s and a boy born in the 1950s. And now remember, a boy born in the 1950s, so the leaders of today were born around about then, like Donald Trump was born in 1947, for instance. And so this tale, I'm going to compare the regimes, and then we're going to compare, how does that compare to where we are today? And so in terms of these two boys, if we look at the boy born in the 1900s, what did he live through? What markets were there? That person who lived between 1900s and 1950 or so, the world order was war-torn, fragmented, rising nationalism. That's what was happening back then in the early 1900s, the first half of that decade. If you look at interest rates and inflation, it was volatile, high inflation, inflation spikes during wars, and high government indebtedness. So that was going on there. If you look at commodities, because it was inflationary, and the world had a lot of violence, actually, and the world was also very fragmented, commodities outperformed financial assets. And then also you look at pandemics and disruptions, there was a Spanish flu. Back then there was a Great Depression, there were the two world wars, and there was the second industrial revolution, where electricity and the combustion engine started to take root. Let's compare that to a boy born in the 1950s. Here, there was global cooperation. There were liberal democracies, and the U.S. hegemony, which is basically U.S. dominance over political, monetary, and military power. The U.S. ruled the world from that point onwards. Also, from an interest rates, we saw falling rates, stable inflation post the Paul Volcker end, and then the world was deflationary. Peaceful, coordinated, and financial assets then actually experienced some of the best periods ever. And at that time, also, there were few shocks, long periods of stability. And there we experienced the third industrial revolution, which is the PC and the internet. Now, remember my Mark Twain quote about the history often repeats itself. When we sit in 2025 and we invest, which ones of these worlds do we actually look at to invest? Because today's world is fragmenting. There's rising protectionism, there's deglobalization, and actually there is the end of the US hegemony, as we have other superpowers starting to rise and take part in running the global economy, the global world. We've also got rising rates, sticky inflation, high government debt levels again. And also, we are, as a positioning, as a house, given all of these fundamentals and what we're going to talk about today, we are overweight commodities. And if you look at pandemics and we had COVID-19, a supply chain, and we've got now new wars. And then obviously we've got the fourth industrial revolution with AI. So when we look at the world, investors tend to have a high recency bias, which means what was most recent is what they think will persist. But actually, when we study the world and study history, we're saying, hey, the world we're living in today rhymes with the history we saw back in the early parts of the 1900s. It's a question to ask. This is deaths in state-based conflicts by region. The world endured a peace dividend, which means low levels of conflict between the mid-1980s all the way to the early 2000s. So is this the end? We're seeing a lot more conflict globally. Also, the world saw interest rates are the price of time or the price of money. Actually, if you look at this long-term chart from the 1700s, interest rates rose and peaked all the way in the late 1970s and then have fallen since. And all of a sudden now, interest rates are starting to rise. When interest rates fall, they are good for financial assets, for equities and stocks. And so that causes that. But it looks like we've come to the end of that. And so therefore, that then starts introducing a headwind. Interest rates were a huge tailwind, but now are they becoming a headwind as they start to rise? Also, we can see this particular chart that government indebtedness, this is US government indebtedness, but it's representative of all government debt levels. It peaked after World War II because wars cost a lot of money and they are not productive in terms of economic productivity. But actually, and then it obviously declined. But now, after QE and all of those measures and COVID, government debt is increasing. So therefore, is this the end of debt-driven markets and economies? So some of the investment returns we have seen actually have been driven quite by debt and very supportive central banks. And I suppose one of the final slides I've got, the second to last slide, is trade openness. You can, again, starting long-term history, 1870 onwards, we can see how there was industrialization and global productivity and trade open. But once we got to the 1940s where the wars are, actually then protectionism, that was not good for trade. And so therefore that was an era of some version of deglobalization. But once the wars were over, then we started seeing one of the biggest economic booms and trade liberalization where the world actually benefited quite a lot from trade openness. And I suppose the questions we're asking where we are today, which direction are we moving? It certainly rhymes more similar to what we saw in the last in the early 1900s. The last slide is actually commodities. When we look at the slide, when the lines on top, commodities look overvalued. This is commodities versus the Dow Jones Industrial Average, which is an index in the US. And when the line is at the bottom, actually 120 years of history. And actually here, relative to financial assets, it also looks like we are back to where we were back in the 60s. So that is my opening salvo, Maya.
Very interesting. So, I mean, such an interesting graph with commodities, the positioning of commodities. And of course, I want to get back to that maybe towards the end with one of the questions I've already got in my mind about that. But given the world of commodities and, of course, gold, one of the things we're all obsessed with, I was telling somebody in America recently that we actually all have the gold price at the end of every news bulletin. You know, that's how obsessed we are with gold in South Africa. Meryl, gold is one of those assets everyone goes to when there's volatility, when there's uncertainty. It's certainly done extremely well. But I have a very important question for you. Mm-hmm. My mother needed to liquidate some of her portfolio, and she sold out some of her gold holdings. Are we going to regret that?
A very good question, Maya. And often the questions that matter on a personal scale also matter on a professional scale, because we are asking ourselves the same. So let's recap, and I'll try and answer your mom's question in the process. We've spoken about gold often on these webinars of late, which makes sense given how the price has performed. So what did we say in September? The price was around $2,400, which for those who had lived through the previous decade already felt extremely high. If you were accustomed to a gold price that started with a one handle, just being in the 2000s felt high. But we said gold was actually ticking, or fewer of the headwinds to gold in that moment were being ticked, and we were not convinced the rally was done. It was up about 50% at that point from its previous low in September 2022. What did we say in November when gold was around $2,600? Looking at the range of trough to peak moves in gold since the 1970s, we said 3,200 per ounce is possible. You know, it feels high, but it's possible if the right conditions play out. And clearly, with hindsight now, the probabilities were, we were correct to point to those probabilities. Let's remind the audience, the listeners, what our gold framework is. So we look at, you know, and gold is the puzzle, the riddle that you can spend your life trying to solve. And just when you figure out what it's correlated to, it's going to change. So we look at several drivers. On the left-hand side, we look at, are you in a weak global growth environment or a strong one? On the right at the top, we look at inflation. Is inflation stable? Is it volatile and high? On the right-hand side, we look at interest rates. Are we in a low interest rate environment or a high interest rate environment? And finally, at the bottom axis, we look at the US dollar. Is it strong? Is it weak? So the easiest is always at the extremes. So let's start at the top left, that reddish maroon. When do you want little to no gold? I call that the Goldilocks box, when everything in the world is going swimmingly. Really think back to the 90s for most of the world. Strong global growth, coordination, peacetime. The axis, we ran out of axes, so you can put a geopolitical wraparound there as well. Peacetime, strong growth, stable inflation, high rates. Why are high rates? Because you can invest in bonds and get a yield. If you invest in gold, you're not getting yield. And a strong dollar. When you have those, that confluence of factors, you want little to no gold in your portfolio. On the extreme, the other extreme in green, when do you want maximum gold exposure? Weak global growth, low interest rates, weak US dollar, and high and volatile inflation. We still today are actually ticking more of the boxes of the maximum gold holding than the Goldilocks era, I would say. However, this is now not a secret. The price is starting to reflect very strongly that we are in that green box. You know, when we spoke in November, when we spoke in September, we were much lower down on this chart on the top left, which I will explain. So what we've got on the top left is analyzing every gold market, every gold bull market from trough to peak, excluding any moves in the gold price of 20%, because in the gold world, 20%, less than 20% is actually not a very big move. So since 1971 to now, the size of that bar indicates how much the gold price rose from the last trough. And the little white number indicates how long that rally lasted. So that green bar is the current gold bull market. And if you had the previous charts, you would see that green bar has been rising from kind of the bottom half, and it's been climbing and climbing and climbing towards the top. The bars in red now are 2001 and 2008. Since the Nixon era, basically our current gold rally, where gold has more than doubled, gold is up 110% since September 2022, which is a big number. That has only been outdone, only been topped in 2001 and 2008 in the post-Nixon era. So clearly those were crises. Those were moments of global meltdown, global panic, and quite extreme. So I would say on a 3-year view, the probabilities are in your mom's favor that you've made the right decision, with the caveat being, unless we are headed for a crisis of the scale of 2001 and 2008. And as we sit here today, I don't have the conviction to call for that crisis. The facts can change, clearly. But I think given the scale of the move that we've seen in gold up to now, it is pricing in a lot of the anxiety. it's reflected in the price, and things have to worsen tremendously from here. That being said, many of the tailwinds are still in place. We do have geopolitical uncertainty. Central banks are still buying. Western ETFs got into the party in this year and started capitalizing on the momentum. GDP is starting to falter and the dollar is starting to falter. The last thing we need is for an interest rate cut to come in the US. We might see one last burst in gold if we get that interest rate cut. However, we have to look at this and say the odds are we are much closer to the top now. What about the stocks? Now, the market is not actually fully ascribing the current gold price to the gold equities. That can be interpreted in many ways. Either the market thinks the gold price cannot prevail at these levels. Obviously, every month that it does, the companies are banking that cash flow because they are selling gold at these levels every day. They are able to pay down debt at a very fast pace at these levels. The other angle to look at it is that they don't trust the management companies of these, of the management teams of these companies to actually manage that windfall cash responsibly and expect value destructive acquisitions. But if we look at these three charts which I've shown, which aggregate Harmony Gold, Gold Fields, and Anglo Gold's some of their financial data and forecasts at various gold price scenarios, so $2,000 up to $4,000. In each of these scenarios, the miners have very strong balance sheets, they have very strong cash flows, unprecedented levels of cash flows, and the third chart looks at the dividend yields. These counters usually trade at dividend yield which is fair of 1.5% to 2%. That is closer to the 2,000 or 2,500 scenario. We now look at this. The market does not believe that 3,000 is sustainable. If it actually does hold for a large part of 2025, which is possible, given the tailwinds that are still in place, there could be further upside to the stocks. Yes.
So I think that's a very interesting play for me. We always forget about that. You've got the actual physical gold, and then I've got the stocks, and maybe that is the option now, is to say, well, we're not sure how much higher gold's going to go, but if it maintains this, if we still think of political uncertainty, which, let's be honest, all we need is China throwing a few missiles out and then all bets are off. But that would actually give upside, obviously, to the gold stocks as well. So a very interesting perspective. Thank you, Meryl. I'm going to be putting Tana on the spot now because one of the biggest, if not the biggest theme of this century so far has been climate change. And that is obviously governments have set targets around emissions, especially vehicle emissions. So the EU committed to having zero vehicle emissions by 2035. Okay, and this had a massively negative impact on our platinum industry because obviously platinum's used in catalytic converters. But Tana, this narrative of electric vehicles is not playing out quite as we expected. Perhaps just give us a little bit of context of what's happening in the automotive industry at the moment.
Thank you, Maya. So yes, let's start with the growth in the automotive sector in terms of global production of cars. This chart over here shows you how the production of cars has looked like starting in 1999. And this is quite important because the automotive sector makes up about 60% of global PGM demand. And now we've seen the growth in car production peak in 2017, but we've seen that the growth in vehicle production per capita, specifically coming out of the emerging markets, has been growing, specifically in China and in India. You are correct in that many countries have set emissions targets within their transport sectors, specifically Europe, which has committed to zero emission vehicles by 2035, and China, who's got a big commitment towards new energy vehicles by the same period. And it's problematic for the PGM sector, given that PGMs are used in the internal combustion engine vehicles. So this entire theme around electrification and targeting and bans for ICE cars has it's had a material impact on our PGM sector, as you've rightly mentioned. So since this chart shows us the global car production by powertrain, and we can see that electric vehicles has been growing over the past few years. There were actually, if you go back a few years prior, the assumption or the forecasts were that we're going to see this J curve in electric vehicle penetration, which you can kind of see on the right-hand side. And today, electric vehicles make up just about 20% of the global car production by powertrain. By electric vehicles, we mean battery electric vehicles, we mean hybrid electric vehicles, fuel cells, etc. About 20% of global car production. And under the proposed targets, where we're looking at Europe, who's targeting 0% internal combustion engine cars by 2035, China, who's got a very big target on new energy vehicles. If we sort of extrapolate this to 2035, the world kind of looks like this, where we've got electric vehicle penetration of about 60%. And you can see in the dark black line, the ICE technology penetration rate of car production dropping significantly. Now, in this world, this is what the basket for PGM demand looks like. And you can see a dramatic decline in PGM demand, about 5% per annum. And this was the chart that many producers looked at a couple of years ago when the theme around electrification of vehicles came into play. Now, obviously, that impacts the capital allocation decision for mining companies. But this is the picture. That's been set for 2035 under the proposed targets. But Maya, there are some challenges with that picture, and there's some challenges with this theme around electrification, and some challenges with the proposed targets that we're going to go through now. So first and foremost, outside of China's, electric vehicles are actually not affordable. And we've seen that, for example, when Germany removed the subsidies for electric vehicles, the demand for electric vehicles actually plummeted. This chart is a little bit busy, but to summarize, outside of China, looking at Germany, USA, and actually other markets around the world, electric vehicles cost about 20 to 60% of the cost of a traditional internal combustion engine of the similar range. So they're not affordable. Secondly, who's responsible for the transition? The OEMs. Now, if you look at some of the big OEMs globally who are required to drive this transition, financially, it's a very capital intensive and expensive transition for them, and they currently do not have the balance sheets to drive this transition through. I mean, this is just looking at the free cash flow margins of the big OEMs. You can actually see Polestar, which is an EV company, in negative free cash flow. This is on top of, so they've had to invest in powertrains for the different technologies, the ICE vehicles, which are still actually generating cash flows, and then the new technologies like hybrids and EVs, the new powertrains that they've had to invest in, which currently actually EVs aren't making that much margin. So it's actually impacting the balance sheets of many OEMs. And on top of that, a lot of the big OEMs are highly levered with debt to equity ratios above 100%. This adds pressure to the transition and challenges. Another challenge that we've seen is that, especially around battery electric vehicles, they're very mineral intensive. Now, over the years, because of technology, we've seen improvements in the chemistry of batteries. But one thing that's consistent is across different battery types, it is still lithium intensive. And we need to understand the lithium market in quite a lot of detail to actually understand how the batteries play out. What we do know is today we don't have enough lithium to support the transition that we saw earlier, where we are meeting Europe and China's 2030 and 2035 targets. So a more realistic outlook of the automotive market kind of looks like this from our own forecasts and research. So as opposed to reaching an electric vehicle penetration rate of 60%, we think 40% is more realistic, with battery electric vehicles accounting for about 25% of this, and this will be predominantly driven by China. I think Europe has got significant challenges when it comes to driving the electrification or the transition. Battery recycling remains the biggest cost for battery electric vehicles, and we're finding that the recycling market for these for batteries is still very, very immature at the moment. So we kind of sort of see 40% as being more of a realistic target, and the internal combustion engine will still account for a big part of the global production of motor vehicles, which means that there's still a demand for PGMs.
Tana, I'm going to interrupt you there before we go back to the impact on PGMs. You know, that slide before around the batteries reminded me of a conversation I had with I didn't have a conversation. I heard a geologist having a conversation, and he was not pro this massive move to pure electric vehicles. And he said because, you know, when we only look at emissions, we look at CO2, we look at the impact on the air quality, right, on CO2. But he said batteries have another huge environmental impact, which we are seeing now. And he was very much of the belief that we should have a little bit of everything rather than committing to one energy source, for example. As an ESG researcher, do you think this pullback in electric vehicles is perhaps actually a bit positive? I mean, what's your take if you're in conversation with that geologist?
I mean, thank you, Ma. That's a very good question. So, first and foremost, when you look at the circular economy for batteries, it's actually not circular. First and foremost, it's very, very mineral intensive from the extraction point of view, which is, you know, environmentally destructive, etc. But actually, even on the recycling part, and I've mentioned that the battery market is still very immature. We don't have a lot of recycling, but it's something that, you know, going forward, if this market can mature, could be quite positive. The problem with battery recycling is black mass. So we've found a way to extract the minerals out of batteries. We've not found a way to actually dispose of the chemicals that are left behind in an environmentally safe way. And that's extremely environmentally destructive. You can look at case studies within Indonesia of streams and rivers getting polluted to a point where we actually have to think about building new tailings facilities just for battery waste. So yes, we've not cracked the code on how to make batteries more of a circular economy in terms of ESG, and that is part of the bugbears when it comes to the transition.
Okay, so it is perhaps, you know, climate change or environmental issues around electric vehicles as well. But let's take this back to the impact on platinum, because obviously catalytic converters, which platinum are used for, are extremely important in reducing emissions in a combustion engine. So really important. What does this mean if the scenario changes? What does it mean for the platinum sector?
Yeah, so I mean, we believe that we're still going to need platinum because we're still going to be producing a lot of internal combustion engine. Mind you, hybrid cars still use an ICE technology, despite the fact that they also have batteries. So in our scenario, we still believe that we're going to have, instead of a 5% annual decline in the basket of PGM demand, we kind of see it more of a 1% annually. But what is actually the problem? You know, 1% annual decline in demand versus almost a supply cliff when it comes to these minerals. This is a snapshot from a northern presentation, but if you look across all of the big PGM producers, it's the same story. And across all the metals, palladium, platinum, rhodium, is that we're going to hit a supply cliff. Because of the theme around electrification, the miners have not been investing in new mineral supply. And the capex that we are seeing is predominantly replacement capex, and we are seeing depleting reserves in South Africa. Mind you, South Africa has got 80% of the world's PGMs. We're gonna have a problem by the end of the decade when we're actually starting to see the demand outstripping the supply of minerals that we actually have. So, and I think, I mean, in conclusion, electric vehicle penetration rates across economies are too ambitious. That's kind of how we see it, and we think more of 40% is more realistic. China is going to be driving a lot of this transition. Most of the large OEMs cannot actually afford to transition. And the exponential J curve that we've all been talking about is more likely more of an S curve, where we're just going to see more, general growth going forward, but not the accelerated growth that we've seen in the past few years. Fundamentally, we will still need PGMs. Fundamentally, this market is not in sunset. And I think given the supply issues, we're going to see a price reaction.
Okay, then I feel like I need to bring Meryl, you back in for my mom's share portfolio. Because now I've been listening to Tana, I'm like, wait a moment. Okay, so maybe she's reduced her gold holdings, but maybe she should be picking up platinum. And I still remember the late 90s, maybe I'm giving my age away, when platinum exceeded gold as in terms of its price, which is why, of course, a platinum credit card is a higher tier than a gold credit card. Do you think we're seeing that again? And how are you positioning, as you know, as the equities researcher, how are you positioning that your portfolios going forward, this gold platinum play?
Yeah, that is a good question, Maya. So in the Investors Fund, which is our flagship fund, we have been incrementally repositioning the relative weight of our gold exposure versus our PGMs. As you can see on the chart, the yellow being gold and the black representing PGM. In December 2023, it was dominated by gold. And where we stand now, 18 months later, it's reasonably equal between the PGM exposure and gold. And we've achieved that by incrementally trimming gold, and within the last 6 months, actually quite aggressively adding to PGMs. But we have been adding over the last nine months. And it's a question of relative conviction. That's how I would frame it. On that slide that I had that showed the potential moves for gold, it's a game of probabilities. If we repeat 2001 or 2008, gold could still get to something between 4,300 per ounce and 4,600 per ounce. But we are nowhere near a trough anymore. The trough is well in the rearview mirror. So the probabilities on those types of prices, we think one has to assign below a 50% chance of that playing out. Whereas with PGMs, particularly in last year, we started to notice the OEM automotive industry bodies, as well as the auto parts industry bodies in the EU lobbying politicians around the speed of the transition, government support for the transition by way of subsidies, because they are starting to take that financial pain and jobs on our at risk within the EU. The way that China has moved to dominate the EV space, while at the same time they are brewing trade wars between the US and China, potentially the EU and China, really for them to pull off the green transition, they have to hand over their automotive industry's market share to China. At this point in time, that feels like quite a politically difficult thing to do. So looking at that, combined with the supply cliff because of underinvestment in South Africa, combined with just the price level versus history of that PGM basket, we felt on a balance of probabilities, we need to position in favor of PGMs over gold.
So that, I mean, that is very interesting. And when you were speaking, I thought, again, it comes down to this. Could happen. There could be an outbreak of further wars. But one thing we do know is there's a definite shift, in the EV market. So you're dealing a lot more with facts that you kind of can work with versus kind of a guessing game. And I think it always makes for better investment decisions. Of course, in hindsight, it's always easy, but looking forward, you have to take the information you currently have and work with that. But Siba, I want to come back to you because obviously South Africa sits with Tana was saying 80% of the world's platinum. So if we see this uptick in demand for platinum, what will that mean to the South African economy?
Yeah, thank you, Maya. So South Africa is a commodity producing nation. To answer this question, we actually don't have to go back too far. So probably 3 years ago, if we look at the budget, the government budget, the one that we struggled to pass now, but let's refer to the 3 years ago.
3 times.
Yes. 3 years ago, we had a budget, this is 2022, 2023, which showed South Africa's projected revenue at that time was, I think, about 1.787, so 1.7 trillion, and of which 300 or so million of that was from 300 billion of that was from corporates, and of which about 40% of that came from mining companies, so resources. And actually, in that budget, when those numbers then fully played out, given what had happened in the PGM market post-COVID recovery, we had, I think, almost a 90 million basically positive surprise in those corporate profits because of what had happened in platinum prices. And so therefore, we come back to today, this budget that we now have passed, it is not that different from the one in 2002, 2022, 2023. It is, I think, 1.8 trillion, so very similar. Corporate profits, again, are looked at as, I think, about just over 300 again. And so therefore, if these platinum prices keep increasing, and obviously gold to a lesser extent, because we, as gold, we've basically mined out a vast majority of our gold in the country, that will be very good for our budget. So we will have a positive surprise. But also, obviously, in a country with as much government debt as we have, a positive surprise is a good thing. And also, that was part of the argument that the other parties were making in terms of passing this budget, because they were also looking at what was coming on underneath and saying, hey, wait a minute, there could be a surprise here.
So basically, the budget could be rescued by platinum. So we kind of, are we now hoping for electric vehicles just not to take off? I mean, is that our solution to our fiscal crisis? But maybe we have to put in a little bit of a political caveat here. And I know you have to be sensitive about what you say, but do you think we have the political will to take advantage of this potential windfall? We have issues with mining license being issued. There's a huge backlash to the amendment bill to the Minerals and Petroleum Resource Development Act. Do you think this is politically, or do you think the GNU is going to help with this? I think this is an important question.
I suppose in this one, Maya, I'll answer it slightly cynically and say, does it matter? And again, we don't have to go too far to recognize that there was an actual windfall of profits in terms of our mining. So South Africa, like Tana said, that South Africa actually mines on the PGM, platinum group metals, 75 to 80% of the world's platinum. The other bits come from Russia. Now, Russia's under sanctions, so let's pretend that doesn't quite exist. And so therefore, either way, if somebody's going to look for platinum group metals, they look them from South Africa. And so therefore, actually, given all of the other things, yes, though there are other issues, but actually that it doesn't prevent that windfall because it hasn't prevented that windfall historically, given our dominance in this one set of metals.
Okay. I'm going to open now for the audience questions. So I need to put my glasses on to be able to see them. So let's have a look at what questions are coming through. A crypto question. Everyone is talking about crypto as being the next gold. What's your view on crypto? I'll keep my thoughts to myself. Anyone here want to take that question?
Yeah, I'll give it a go. So I think the argument for crypto is that it is much like gold, an alternative currency, and it's outside of the current financial system. My expectation is for that to become increasingly regulated and co-opted by central banks. I struggle to imagine a world where central banks actually allow this to become of such a reasonable scale that it can actually disrupt their power over the fiat currencies that they control. And we've seen, be it China, America, where central banks are trying to digitize or launch their own, versions of digital currency, I think, to displace, the rise of these. I think the blockchain technology behind it, many companies are using that for security and for trade, but I struggle to see how it really replaces gold.
Can I add to that,
Yes.
Maya? I mean, this is obviously always a contentious debate, and we always get these questions. But I mean, if we go back to first principles, what is a currency? I think we've got to first answer that question. And a currency meets several criteria, but I'll talk about two of them. I mean, it has to be a unit of exchange, which means you can go and buy. It's accepted tender. That's the technical word for it. And also, I suppose it must be a store of value. And so this is why inflation is such a problem, because the currency must be a store of value. So if we look at this particular, so Bitcoin in this instance is not necessarily a unit of exchange, because we aren't. Yes, now in theory there are these places where you can go, but it's not an acceptable and a widely held unit of exchange where I'm not going to go to Pick and Pay or whatever other shop and buy from there using my Bitcoins in a wide space. And so that's the first issue. And the store of value, it's actually quite interesting to watch how gold versus how crypto actually navigates these global shocks. So even last week with all of this, okay, now we've got an escalation in the wars, crypto declined, gold went up. And I think the other fundamental question that we've got to ask ourselves with that is that with crypto, so obviously we started with the original, the OG of cryptos being Bitcoin, and that the thing is Bitcoin is also scarce because it's limited in how many you can have. Whereas with and the problem with that is that now there are all sorts of other cryptos there. And so therefore then it starts challenging the store of value, because with gold is very difficult to mine. It is very rare. And actually there's a lot of energy that's to go in. So far, actually, the new here is not beating the old. And under pressure and under stress, gold is certainly holding up far more than what any other crypto does.
I think the point you make about the correlation is so important. Crypto has not proved itself to be non-correlated.
Yeah.
And what do you want with an alternative asset? You want it not to have a correlation with the markets. And I think that's probably a very powerful comment. I did see a question earlier about, should you really be adding platinum and gold to your portfolios? That's kind of the question I was asking about my mom. Should you be adding them at this point? Maybe that's a different question to holding them. Should you be adding them, Meryl?
Yeah, so I think PGM, as we discussed, is the easier one. So if I had zero PGM in a portfolio, I would definitely be adding today, and adding with quite high conviction, given the story we've laid out. I think over time, gold, and my answer will sound like a stuck record with this answer. I believe that gold has and proves its role in a portfolio in some weight. I think somewhere between 5 and 10% in a portfolio over time. And I'm not talking about someone who's trying to trade and make money in the next 6 months. I'm talking about an investor with a 5-year time horizon. There is so much uncertainty in the world today that gold absolutely has a place in your portfolio.
As an insurance policy. I always think gold's such a nice insurance policy. We all have insurance. Well, some of us do.
Yes.
And that insurance plays a specific role. And I think in an environment like we're in now, it is a nice little insurance.
But let's say a year ago you had 5% of your portfolio in gold. That insurance has doubled, right?
You'd still be holding 10%.
So by all means, take that 10% back to 5. Take some profits.
So my mom did the right thing, telling me. Oh, she's so smart. Okay. Well, okay, it was also with my advice. I just have to say, I don't charge though for my advice too. So gold, hold, sell, buy, or walk away. I think you've kind of answered that. Keep a little bit of it in your portfolio. It's still got some uses. Let me see. I need to put my glasses on to see the next one. So environmental costs. Oh, this is very hard to read. Mining. Okay. I'm trying to read this, but it's being typed as I'm writing. Environmental costs. EVs have environmental costs in mining, energy use, and battery disposal. What's needed to ensure their overall life cycle supports the long-term sustainability? Tana, that's definitely your question.
Yes, I'll go for it. So talking to batteries, I think, yes, you are correct. They've massive environmental costs there. I think right now we do not have a well-functioning battery recycling market that needs to be established. And I suppose it it's one of those chicken and egg kind of thing. You need to have more EVs to build a proper battery recycling market, but you need batteries to have more EVs. So it's one of those things. But I think we just need a well-regulated battery recycling market that speaks to how we recycle batteries, and that's still very immature at this point in time. But there are other technologies outside of batteries which are still very small but emerging, like hydrogen fuel cells. But again, research into that is still very limited at this point in time. But that would be a lot more environmentally safe relative to batteries. But I think, yes, for sure, I think globally we just need a battery recycling market with the chemistry necessarily to process black mass in a sustainable fashion.
Tana, I want to pick up a little bit on what your comment was on the hydrogen cells. And one of the things you do see with new technologies is they often need that government support in the beginning. It does need support. There does need to be investment to allow these to reach some sort of critical mass so that they become more ubiquitous and are able to be used in the mainstream. So it's a difficult one as to how one goes around changing these technologies. But yeah, that is one of course, the challenges going forward, is that in order to bring any change, there's generally a huge cost to it until that comes about. But we live with the costs of the environment. So a good question, a very good challenging question. Are there no more further questions from the audience, I think? Are we good? Okay, we can wind up.
I think can we go back and frame the world we are investing in, which also touches on the gold and what Meryl talked about, which is on why gold is essential in the portfolio, especially today. And I suppose the way we've looked at it is saying it's why we started off by looking at someone who was born in the 1900s and lived up until 1950, and the person then going forward, and what does that mean for the world? And I think we've got to appreciate the fact that the world is changing. And these changes, when they're happening, you're not aware that they're happening, but actually you can see they last for very long periods of time. If I give us another way of framing this, that post-World War II, obviously, the United States played a major part in World War II at the very end, and the United States wasn't damaged by World War II. And so therefore, but then they had the space to be able to rebuild, to build their consumer market, to outsource manufacturing to all sorts of countries globally, and they became the dominant economy and the dominant military globally up until around about now. Now, in the middle of that, then what we've seen Trump get elected. One of the first and most important speeches that happened was J.D. Vance, his vice principal, going to Europe and saying, hey, we are going to break up. Now, why has that been a thing? Because, well, he's saying the US has got too much debt, which we showed earlier, and so therefore they can't afford being the world's police and the world's, I suppose, hegemon. That's what it's called when you are the dominant person. The other part of it is that given that they can't do that anymore, but also there's no longer one global superpower. So we used to live since the 1950s in a unipolar world where there's one that dominates and controls everything. Now we're living in a multipolar world because China is important and is a superpower. Russia is resurging as a superpower. And so therefore, India is growing and growing as a superpower. And so therefore, from that perspective, you're saying, hey, the world is no longer what it has been. And in a world that is transitioning, where interest rates are higher, where there's more government debt, where there's more war, therefore, actually, you are finding you have to carry insurance as an investor, which is where we are saying with gold. And actually, you've got to figure out how to build more robust portfolios. Because what we've experienced, we have lived, I think, a world with very high equity returns, very, very strong markets, low inflation, low interest rates. And I suppose the question we're asking is saying, hey, history is saying this is unlikely to continue.
This time it is different. No, but it's not different. It's just going back to a previous era. And I mean, I think that is really, really important. Meryl, anything you want to add to that?
Yeah, as Sibo said in the beginning, our funds are positioned overweight commodities at this point in time. So I think it's not necessarily which commodity. I think commodities in general, we are saying, should benefit. Some of the themes we're talking about of underinvestment and low supply apply across the board. today we particularly wanted to speak with conviction on PGMs because, and within the commodity spectrum, we are still tilted towards precious metals, but we are shifting.
So move to the glittery stuff. And you, Tana?
I think just to end off on PGMs, like I mentioned earlier, that we have the most of the world's resources of PGMs, but actually they're also very important for South Africa because the PGM industry is the biggest employer within the mining sector, about 180,000 jobs, and we know within South Africa, one mining job doesn't just mean one mining job. There's a multiplier effect in terms of the household. And we know that communities around mining towns, so, the hairdresser, the little tuck shop, it's all supported by this mining industry and community. So it is very, very important from, I think, an investment point of view to understand, the positioning for PGMs. But I think from a South Africa societal point of view, like this is an industry that is extremely important. And, the supply cliff is still there, and we need to think about, to your comment around regulations within the DMPR, how to actually make sure that the mining sector continues to be sustainable into the future.
That was a great way to end this conversation. And I think thank you to all of you listening. And I think what I take from this is hope for our economy, actually, and also the fact that we live very far away from all the nuke countries. we should be safe from all the wars. And there is uptick in the platinum, but I do hope our ministers and regulators are listening and realize that there is an opportunity once again for us to perhaps benefit from global change. So thank you, and thank you to all of you for joining us, and thank you to those who joined online.